There's a pattern emerging that deserves attention. Central banks held an unscheduled coordination meeting last Saturday morning, not their regular quarterly symposium, not the standard monthly check-in, an emergency weekend session that wasn't on any official calendar until 72 hours before it happened. I've been tracking these institutional movements for 2 decades, and when you see the world's financial architects scrambling to synchronize their messaging on a weekend, something fundamental has shifted beneath the surface. The official press release mentioned liquidity coordination and market stability frameworks. Those are the exact phrases they used in September 2019, 3 weeks before the repo market seizure that almost collapsed the overnight lending system. Let's talk about what's actually happening with silver, because the weekend meeting and the silver situation are connected by threads the mainstream financial media refuses to acknowledge. The last time silver crossed $32 and held that level for more than 3 trading sessions, we saw a coordinated intervention within 6 days. Price discovery became price management. This time, something different is unfolding. The COMEX inventory data tells a story that should concern every central planner watching from their mahogany conference rooms. Registered silver, that's the metal actually available for delivery against futures contracts, has dropped 37% in the past 14 weeks. Not months, weeks. We're looking at the physical foundation of the paper market, evaporating while trading volume increases. That's not a healthy market finding equilibrium. That's a game of musical chairs entering its final round. Physical demand from industrial users has created a supply crunch that can't be solved with mining output increases. You can't just turn on a silver mine like flipping a light switch. Development timelines run 5 to 7 years from discovery to production. The technological revolution requires silver. Every solar panel, every electric vehicle, every 5G infrastructure component, every advanced weapon system, they all demand silver in quantities that seemed absurd 10 years ago. Here's the crucial part. The automotive sector alone is projected to consume 88 million ounces this year. That's a 32% increase from 2023 levels. Electric vehicles use 2 to 3 times the silver of traditional cars. Photovoltaic applications are on track for 140 million ounces. We're not talking about jewelry demand or investment coins anymore. We're talking about industrial consumption that doesn't have substitutes at current technology levels. The banking sector knows this arithmetic doesn't work. They've known for at least 18 months. The short positions held by 4 major institutions represent more physical silver than exists in available inventory, not registered inventory. Total available inventory when you include the London vaults and private storage. This is the foundation of their weekend panic. I want you to understand how derivative exposure actually works in precious metals markets, because this is where the emergency meeting makes perfect sense from their perspective. These institutions don't just hold short positions in futures contracts. They've written options, structured products, and customized derivatives for industrial clients who need price certainty for their manufacturing inputs. When silver moves $4 in a week, those derivative books start flashing red across every risk management dashboard. The Federal Reserve, his balance sheet, still carries $7, $3 trillion in assets, despite their quantitative tightening theater. They've reduced it from $9 trillion shore, but they're trying to convince markets that a $7. $3 trillion balance sheet represents tight monetary policy. That's like someone claiming they're on a strict diet because they reduced their daily donut intake from 12 to 9. The monetary base remains catastrophically expanded compared to historical norms. What's remarkable about this is silver remains the only major commodity trading below its 1980 inflation-adjusted high. Gold surpassed it. Oil exceeded it. Copper blew past it. But silver, the monetary metal with irreplaceable industrial applications, trades at 1/3 of its inflation-adjusted historical peak. That discrepancy isn't market efficiency. That's active price management finally running into physical reality. Let's explore what happens next. The paper market and physical market are diverging. This has happened before in other commodities. Uranium in 2007, palladium in 2000. When paper contracts promise delivery of physical material that does not exist in sufficient quantities, you get a reset. Sometimes orderly, usually chaotic. The mining economics tell you everything about future supply constraints. All-in sustaining costs for primary silver miners average between $18 and $24 per ounce, depending on jurisdiction and ore grades. Secondary production from base metal mines adds another layer, but those operations optimize for copper or zinc or lead. Silver is a byproduct. When base metal prices weaken, secondary silver production drops, even if silver prices rise. You can't increase silver output by trying harder when it represents 3% of a copper mine's revenue. I've watched the lease rate markets for precious metals for years, and what's developing right now should alarm anyone paying attention. Silver lease rates have gone negative multiple times in the past 6 months. That means people are paying to lend their silver rather than receiving interest. In a normal market, that's insane. In a market where physical metal has become critically scarce for settlement purposes, it's a distress signal. The institutions that need to borrow silver to meet delivery obligations are in trouble. This is worth repeating. Negative lease rates mean the paper market is so desperate for physical metal that they'll accept financial losses just to access borrowable inventory. The carrying costs exceed the lease income, yet they're still executing these transactions. That only makes sense if the alternative is failed delivery and contract default. The Chinese accumulation strategy operates on a time frame that makes Western quarterly earnings cycles look absurdly short-sighted. They've been converting dollar reserves into commodities and commodity production capacity for 15 years. Their solar panel manufacturing dominance is not about climate policy. It's about controlling the supply chain for the metal those panels require. They're not stockpiling silver bars in a vault. They're transforming silver into installed solar capacity that generates power while removing physical metal from global circulation forever. Industrial users are shifting from just-in-time inventory management to just-in-case stockpiling. When major electronics manufacturers start holding 6 months of silver inventory instead of 6 weeks, that's millions of ounces removed from available supply. That silver isn't coming back to the market. When prices rise, it gets consumed, turned into circuits and contacts and components that end up in phones and cars and weapon systems. The weekend meeting included representatives from the European Central Bank, the Federal Reserve, the Bank of England, the Swiss National Bank, and the Bank of Japan. That's not the standard G7 finance coordination. That's the core banking institutions that backstop the derivative markets where precious metals trade. When those five gather on short notice, they're not discussing interest rate policy. They're managing a specific crisis. Here's what they fear most: a visible default on a major exchange. If COMEX or LBMA has to cash settle contracts because physical delivery becomes impossible, the illusion shatters. Every industrial user, every investment fund, every sovereign wealth manager suddenly realizes that paper claims aren't the same as physical metal. The scramble for real material would make the current situation look calm. The ratio between paper claims and physical metal varies depending on whose analysis you trust. But even conservative estimates suggest 100 paper ounces trade for every physical ounce. Some analysts argue it's closer to 250 per 1. The exact number matters less than the relationship. So when markets function normally, this creates liquidity and price discovery. When stress appears, it creates a catastrophic mismatch between promises and deliverable reality. Let's look at the historical precedents, because they're instructive. In January 1980, silver hit $50 as the Hunt brothers' accumulation met inflationary panic. The exchange changed the rules mid-game, margin requirements increased, position limits appeared overnight, trading became liquidation only for holders above certain thresholds. The price collapsed, not because supply suddenly appeared, but because the institutions changed the game rules to force sellers into the market. Could they do that again? Absolutely. Will they? That's the trillion-dollar question. The difference between 1980 and today is the nature of demand. The Hunts were speculators who could be forced to liquidate. Industrial users can't be forced out of the market. Samsung can't build smartphones without silver. Defense contractors can't manufacture missile guidance systems without silver. Solar installations can't happen without silver. You can change exchange rules, but you can't legislate away the periodic table. This is the key insight. Price suppression works when demand is discretionary. It fails when demand is essential and supply is inelastic. We've crossed that threshold. The industrial demand floor is now higher than available supply at current prices. That's not a temporary imbalance, that's a structural shift. The $80 silver target isn't speculation, it's arithmetic. If silver simply reverts to its historical ratio with gold, you get prices in the $140 range at current gold levels. If it reaches half its inflation-adjusted 1980 high, you're looking at $125. If it just reflects actual supply-demand fundamentals without manipulation, conservative models suggest $65 to $85 is the equilibrium range. The question is not whether silver reaches 80. The question is how violent the journey gets and whether it stops there. Central banks have been net buyers of gold for 14 consecutive years. They don't report silver purchases because silver isn't officially a monetary metal anymore. Except China includes silver in its strategic reserves data. Russia includes silver in its commodity stockpiles. India's import data shows consistent silver accumulation beyond industrial and jewelry demand. These are not market participants. They're sovereign actors preparing for a monetary system that looks different from today as dollar hegemony. The emergency weekend meeting almost certainly discussed intervention strategies. They have several options, none of them good. They can raise margin requirements to reduce speculative participation. They can implement position limits to prevent large accumulations. They can pressure allied governments to release strategic stockpile material. They can arrange coordinated central bank leasing of metal into the market. Each option buys time, but doesn't solve the structural deficit. The really fascinating development that nobody is discussing: Several major hedge funds have quietly shifted from shorting precious metals to accumulating long positions. These aren't gold bugs or conspiracy theorists. These are quantitative funds running algorithms that detect statistical anomalies and structural imbalances. When the smart money reverses a decade-long positioning, you should pay attention. I've seen the redemption data from silver ETFs, and it reveals something the price charts don't show. Large institutional holders are redeeming shares and taking physical delivery rather than selling for cash. That's unusual. ETFs exist to provide price exposure without the hassle of physical storage. When institutions start taking delivery, they're explicitly rejecting paper claims in favor of metal in hand. That's a vote of no confidence in the paper market's ability to settle contracts. The mining sector can't rescue this situation. Global silver mine production peaked in 2016 at roughly 900 million ounces. We're now running around 830 million ounces annually, and the decline continues as ore grades diminish and easily accessible deposits deplete. New discoveries aren't keeping pace with depletion. The project pipeline for the next 5 years won't offset the decline curve from existing operations. Recycling provides maybe 180 million ounces annually, but that's already baked into the supply equation. You can't dramatically increase recycling when most silver gets consumed in applications where recovery is economically impractical. You're not going to recycle the silver from solar panels installed on someone's roof. The quantities are too small, and the labor costs too high compared to the metal value. So you've got annual demand around 2 billion ounces, including industrial, jewelry, investment, and silverware. You've got supply around 1 billion ounces, including mining and recycling. That's a structural deficit of 200 million ounces that gets filled by drawing down above-ground inventory. That works until inventory depletes below the level needed to maintain market confidence. We're approaching that threshold. The technical picture shows silver consolidating above resistance levels that have capped prices for 3 years. The breakout above $30 with sustained volume isn't a temporary spike, it's a regime change. The trading algorithms recognize this pattern. They're programmed to follow momentum once key levels break. That creates a feedback loop where technical buying reinforces fundamental demand. Here's the crucial part. The banks that held massive short positions have been quietly reducing that exposure. The commitment of traders reports show commercial short interest declining over the past 6 months, even as prices rose. That's extremely unusual. Normally, commercials add shorts into rising prices to provide liquidity and capture premium. When they're reducing shorts instead, it suggests they're prioritizing risk reduction over profit maximization. That's fear-driven positioning. Here's an angle that deserves more attention. The weekend meeting probably tried to coordinate a messaging strategy. They need to manage expectations without triggering the panic they're trying to prevent. If a Fed official says silver markets are functioning normally, markets hear, we're concerned about silver markets. If they say nothing, the silence creates its own speculation. They're trapped between communication options that all carry risks. Watch what happens with COMEX delivery notices in the next 3 contract months. If we see unusual numbers of contracts going to delivery instead of cash settlement, that's physical demand, overwhelming paper trading. If we see cash settlements at premiums to spot price, that's admission that physical delivery has become problematic. Either signal confirms that the paper market is losing its ability to suppress physical reality. The geopolitical dimension amplifies everything else. Silver appears on every critical minerals list published by every major economy. It's classified as strategically important for national security, energy transition, and technological competitiveness. When commodities achieve that status, markets stop functioning as pure price discovery mechanisms. Become theaters of strategic competition where nations prioritize access over cost. Let's explore what happens next. If silver reaches $50 and holds that level, the derivative exposure at major banks becomes genuinely problematic. Their risk models never contemplated sustained prices above $35 because historical manipulation always capped rallies. When your risk models are based on the assumption that you can control prices, and that control slips, you face losses that weren't supposed to be possible. I want to be clear about something. This isn't investment advice. This is pattern recognition based on publicly available data that most people aren't bothering to synthesize. The emergency weekend meeting happened. The COMEX inventory data is real. The industrial demand numbers come from industry sources. The mining supply constraints are geological reality. You can verify every factual claim I've made. What's remarkable about this is the mainstream financial media isn't covering any of this. CNBC talks about silver when it spikes 8% in a day and forgets about it. Bloomberg runs occasional commodity roundups that mention silver in passing. The Financial Times treats precious metals like curiosities rather than critical industrial materials. That information suppression is itself revealing. The institutions need retail investors to stay confused and disengaged. An educated public asking for physical delivery would accelerate the crisis they're trying to manage. So they marginalize the discussion. They make precious metals seem like fringe interests for conspiracy theorists and survivalists, rather than rational responses to observable monetary and commodity trends. But industrial users can't afford that luxury. They need silver to manufacture products, regardless of whether CNBC covers the market. Their procurement teams are having increasingly difficult conversations with suppliers about delivery timelines and price volatility. That real-world friction is where paper markets meet physical constraints. The solar installation pipeline alone represents contractual obligations to consume more silver than the market can supply at current prices. Those purchase agreements are already signed. The installations are already planned. The financing is already arranged. When your business model requires a material that's becoming scarce, you don't wait for prices to fall. You secure supply, whatever the cost. Defense contractors operate under similar constraints. You can't tell the Pentagon that you'll deliver those radar systems when silver prices come down. You have a contract with performance penalties. You buy the silver you need at whatever price clears the market. That's inelastic demand meeting inelastic supply. This is worth repeating. Industrial users with contractual obligations create a demand floor that does not respond to price signals the way discretionary buyers do. When that demand floor exceeds available supply, price has to rise until either new supply appears or demand gets rationed. There's no new supply coming quickly, so we're moving toward demand rationing by price. The 80 target starts to look conservative when you run scenarios where industrial demand continues growing 12% annually, while supply grows 2% annually. You either get much higher prices or you get physical shortages that disrupt production. The market will choose higher prices because the alternative is industrial chaos. Here's what you should take away from this. The emergency weekend meeting signals that the institutions managing the paper silver market recognize they're losing control of the physical market. They're coordinating their response, but their tools are designed for financial engineering, not geological or industrial reality. They can manipulate prices on exchanges. They can't create silver that doesn't exist. They can manage narratives in media they influence. They can't change the fundamental arithmetic of supply and demand. The path to $80 silver isn't smooth or guaranteed. We'll see volatility. We'll probably see orchestrated sell-offs designed to shake weak hands. We might see regulatory changes intended to cool speculation. But underneath all that noise, the structural deficit continues. The industrial demand continues. The mining supply constraints continue. And eventually, physics defeats financial engineering. Watch the delivery data. Watch the inventory levels. Watch what industrial users are saying in their supply chain reports. Watch what mining executives are saying about development timelines. Those signals matter more than price commentary from analysts who have been wrong about precious metals for 15 years. The weekend meeting happened because something broke or is about to break in the plumbing of the silver market. They're trying to fix it before it becomes visible to everyone. Whether they succeed or fail will determine how violently silver reprices. But the repricing itself is now inevitable. The only question is timing and magnitude. And based on what I'm seeing in the data, we're closer to the beginning of that repricing than the end.